The Brexit referendum announcement at the end of June 2016 in the UK did more than just send shockwaves through stock markets. Changes in currency values affected the affordability of residential and commercial properties across Europe, resulting in new trends for international property investment in the world's largest single market. In some cases, the currency swings were instant incentives, acting as cues to push through deals as quickly as possible. And in others, the changes took the form of fiscal nudges, simply reminding property investors of the value that's been prevalent in some currencies for well over 6 months now. We're going to take a look at some of the currencies which have seen the biggest movements and also how these have affected the property markets and appetites of investors. By September last year, the Brazilian real had dropped to more than 15-year lows against the euro. The country's faltering economy was a big reason here, especially after such a meteoric rise, but more recently it was because uncertainty had gripped the country following the suspension of the country's president in what was democratically considered a political coup d'etat. Since then, the real has grown in strength considerably on the euro, rising from 0.221 in February this year to 0.274 in August. That's an increase of 24% in just 6 months. But what does this mean in real terms? Well, for the Brazilian buyer targeting a €1 million property 6 months ago, they would have required around 4.5 million reals. For the same €1 million property today, they now need just 3.5 million reals, a saving of not far off £1 million. Here at Athena, we've noticed the effects of this currency swing already. More Brazilian investors are targeting renovated and new build properties in Spain, Paris, and particularly Lisbon, where there is a historic cultural synergy. In fact, for Lisbon and wider Portugal too, the country's popular Golden Visa program is already doing much to attract property investment without the help of currency swings. The Real Estate for Residency program, which requires a minimum of €500,000 in investment into property, has so far attracted almost €2 billion and is the most popular real estate for residency program of its kind in Europe. On the whole, 2015 was a pretty good year for British buyers targeting familiar European locations like France, Spain and Portugal. Back in July last year, the pound reached an 8-year high on the euro at 1.44. Now, this was the best value British property buyers in Europe had enjoyed since 2007, before the recession. Since these highs, the pound followed a general downward trend, hovering around 1.26, 1.30 in the lead up to the Brexit referendum. Since then, or over the last 12 months, the pound has tapered, and so has British buying power in Europe. Yet, in certain markets, contributing factors have helped reduce this effect, and in some cases, negate any loss in currency values. For example, in France, the continued decrease in mortgage rates available to non-residents has enabled purchasers to retain value in their investments. Research from French private finance shows that whilst a sterling-powered euro deposit has become 20% more expensive since July 2015 due to the weakening of the pound, because mortgage rates have dropped, so has the total amount of interest payable over a 20-year term. Now, of course, while deposits for properties are upfront cash costs and mortgage interest is paid off over the duration of the loan, buyers are finding that the numbers here essentially balance out, enabling them to retain reasonable buying power on the whole. In March 2015, the US dollar hit 18-year highs on the euro, almost reaching parity with the single market currency. This was a critical point in time for dollar investors from the US, but also those from the 12 countries whose currency is pegged to the dollar. Investors of all types, from institutional to holiday home buyers, have moved quickly to exploit this value. American investors focused on properties in Paris, and Western expats in the Middle East and Far East have used the opportunity to purchase holiday homes in traditional areas around Europe. Still today though, those buying euro property with the dollar enjoy very favourable conditions, with the USD EUR staying above 0.90 for the majority of the last 16 months. In the past 2 years, the dollar has strengthened by around 24% on the euro, representing a huge saving on purchase prices. In July 2014, a €1 million property would have cost around $1.4 million, whereas today, those buying with the dollar require substantially smaller investment amounts, of around $1.1 million. The actual saving here is around $280,000. Now this is where we've seen the most movement recently. As most of us know, in the space of 6 hours over the morning of the 24th of June, the UK's Brexit referendum announcement caused the pound to slide by the most on record against the dollar, reaching its lowest level since 1985. London real estate has long been the staple diet of foreign investors, and whilst there's continued uncertainty as to how Brexit will affect the UK economy, its political scene, and ultimately the property market, this change in value was a fresh reminder of the power that the dollar has had since the 2008 downturn. Now, whilst domestic and international demand in the UK property market is expected to waver over the next 6 to 18 months, new opportunities for those where currency provides tangible value are expected to crop up.